morning. It's 5 a.m. in New York City. I'm Matt Miller in for Danny Berger here with your Bloomberg Brief. This is what you need to know. Equity futures waver to wrap up a week that was entirely in the red. Maybe we'll see some green today. That's as markets await Fed Chair Powell's speech at the Jackson Hole Symposium. We're going to bring you that live with special coverage all morning. And Nvidia is said to have asked its suppliers to halt production on its H20 chips. We'll take you through that story as well. Take a look at futures here. We are in the green today. As I said, every single day this week has closed in the red, but S&P futures now are about 0.2% higher. NASDAQ futures a little bit less, only 0.1% the gain there. The small caps are doing the best as markets await any sign of a potential rate cut in September. Odds are still betting on a 20 basis point cut. For some stock stories to watch right now, let's go to Valerie Teitel. She's in London with the latest. Valerie? I'm not sure if Valerie's microphone is on there. All right, we'll get back to Valerie and get that stocks news to you as soon as we can. We have her. Sounds like we have her back. Valerie, are you good to go?
Maybe I'm good to go. Can we start with Nvidia in the red, falling around 1%? And this is coming after reports that they have paused production of their H20 chip. Remember, that chip was a chip designed specifically for the Chinese market. And this comes after China has urged local firms to not use this chip on the back of some security concerns can be seen as maybe these trade negotiations reaching new levels when it comes to the chip industry, and maybe a broad move by China to keep protecting its homegrown chip industry. But let's move on to earnings. Let's talk about Workday. This is the HR software firm. They gross profit missed estimates, but they did announce a new acquisition of their second AI-linked acquisition. They agreed to acquire Paradox, which will help them automate some of their recruitment process. Lastly, let's end also with earnings. Zoom Communication gave a strong forecast, Matt, and this is off the back of customer demand for its new suite of AI tools.
All right, Valerie there with a wrap of some of the stocks we need to be watching this morning. In just moments, we are going to push ahead to Chair Powell's remarks with Geoff Yu of BNY. And later this hour, we're going to talk to Caffrey of JPMorgan to discuss the equity market and the reactions that we've seen. We are about 5 hours away from the highly anticipated speech from Fed Chair Jay Powell. Let's get a preview right now from Bloomberg's Balazs Pence. Balazs, what exactly can we expect, or what are we presuming to expect from Fed Chair Powell today?
Well, what everybody's hoping for is some sort of a hint, a wink and nod in terms of the direction of monetary policy from Chair Powell. And he has used the Jackson Hole meeting before to indicate which way rates might go. What markets will be particularly looking for is whether he gives any sort of pushback to the market pricing that's developed, particularly since last week's relatively benign inflation report. But as we have seen, as we heard from several Fed members, past and current, there is sort of an emergence of a focus on the underlying data, and there's more of a focus returning to inflation concerns rather than the jobs market, which everybody assumed would have made a September rate cut a done deal. So there's a lot riding on this speech, and people will be very eagerly parsing every single word out of Chair Powell's mouth.
All right, so what are the other sort of, I guess, events that we need to be watching for? I know that we have at least one labor report coming between now and the September meeting, and a few different inflation reports. What are the biggest data points that you think Powell and his colleagues are going to be looking ahead to in the next month?
As we heard from several Fed speakers over the past week or so, they have been more concerned about the underlying data, and they have pointed at the pickup, for example, in services inflation that's indicating that there's more inflationary pressure in the economy, and they're of course still looking at any sign of the tariff pass through into the inflation numbers, and whether that's a one-time blip in the numbers, or whether that's kind of a more prolonged effect on inflation. And there's another thing in the background that we still have to talk about, which is this tussle between President Trump and Chairman Jay Powell over which way the Fed should go. There's been a lot of talk about central bank independence, and Powell will be among friends. It's a safe space for him, with a lot of other central bankers present in Jackson Hole. So it might not be a surprise if he also makes a nod towards central bank independence during his very highly anticipated speech.
All right, Balazs, thanks so much. Balazs Pence there talking to us about what to expect. Joining us now is Geoff Yu, Senior Market Strategist at BNY. And Geoff, one of the things we're expecting to get is perhaps a change in the framework the Fed uses to go about monetary policy. What are you expecting?
Well, overall, going to the September decision itself, we're not expecting really a full-throated endorsement of market pricing, to your earlier question. So, yes, markets are looking for a cut. So maybe we'll lean in that direction. But is it going to be a full endorsement? I'll go back to Goolsby's comments. Yes, it is going to be a live meeting. Secondly, let's look at the theme of Jackson Hole this year. Labour markets in transition, right? Demographics, productivity, macroeconomic policy and things like that. So going back to the core inflation numbers, which have been rising, especially the services figures. So that speaks back to the labour market in places like the US and the UK, where wages really the key input into services inflation. Are there structural trends taking place, which means inflation will be elevated, and then you have higher terminal rates or higher neutral rates? So I think all of this will be under discussion as well. But overall, balance, I think that's going to be the key word. Let's not rock the boat right now.
Each day this week, Geoff, I check out my WIRP function, my WIRP function, and here we have odds of 75%. That's a little bit dated, because right now I'm looking at less than 71%. To put it in odd terms, 17.7 basis points of a cut. What do you think we're going to see? Because last week at this time, we may have thought 50 basis points would be appropriate.
Well, so is it fully justified right now, just based on the data run that we've had, especially with respect to prices? Probably not in that sense. Is a cut at some point this year justified, given the direction of travel for the labour market, for the economy? So yes, right. So we just have to look at the short term, medium term, put things into perspective. But let's look at the global policy framework right now. Again, here, the BOE. If the BOE had seen the data on the inflation side, on the labour market side, on the GDP side before their cut, I don't think they would have cut, right? I know you can't prove the counterfactual, but I do think that central banks globally, and in particular with the Fed, with high frequency data, coming through, they don't want to fall into that trap as well. So don't end up regretting something just because of forward-looking data that you didn't have.
If I looked at inflation, I would think it's going higher and higher, just from the CPI and PPI numbers, which then begs the question, does the Fed really want to cut rates into rising inflation that's already 60% above its target rate? But I guess a lot of people, Geoff, question the components of the inflation numbers that we get. Are you among them?
So I would actually go back to the services print, right? So it is still above 2%. It's been consistently at those levels. But that just speaks to wage growth. I know wage growth isn't exactly accelerating to the extent that maybe headline figures are lurking in that sense. But if we look at, where the inputs into the US economy are, so where the drivers are, I think they should be concerned that, similar to the UK, while labour markets are clearly cooling, they are loosening in terms of jobs numbers, you're not seeing that directly translate into weaker wage growth as well. That's the gap right now. BOE's been talking about it. They anticipate that to happen for 6 or 7 months. It just hasn't happened. It's surging, if anything. You talk about US services inflation at 2. In the UK, it's almost at 5. So in that context, I think they need to look at the structural aspect, so that outside the immediate issues surrounding September rate cut is what I'm looking for within the debate amongst the central bank governors at Jackson Hole as well.
You keep mentioning the UK, and it worries me. Do we really compare the US to the UK economy? I mean, is the US economy in that bad a shape?
No, certainly not in terms of stagflation, right? So we're talking about UK services inflation, more than twice the level of US. But these are two economies which are particular within the G10 as having far greater input in driving growth in consumption, in services. So I think that's where we just need to be a bit more attuned to the different dynamics and why that link between slower labour market growth and wage growth. Why has that link broken down? I really think that needs further exploration. And also, we need to run the risk of, or just face the risk that the central bankers might just say, wherever you are, well, services inflation, the supply issues, the structural issues in the labour market, demographics, again, a theme at Jackson Hole. It's just something that is not the central bank's role to really resolve. So how much is fiscal impulse, how much is fiscal spending feeding into services inflation as well from public services globally? That is something to look at as well. So I actually worry that central banks, they look at their scenarios, the Fed, looking at their own scenarios and just say that a lot of inputs into inflation, just things we can't deal with. They need to lean back on the government.
Geoff, one of the parallels I've been thinking about lately is the UK used to be the dominant global economy, used to have the world reserve currency. That's obviously declined. How about the dollar? How much of a problem are debts or threats to the Fed independence or threats to other economic institutions in the U.S.? How much of an effect has that had on the dollar's spot at the top?
Right. So I'm glad you asked that question, Matt, because really it is a theme, especially since April, that it's something that's talked about but not really actioned upon. So the dollar has adjusted, but if anything, our custody data showed euro was probably a bit too underheld, a bit overhedged in the first place and at the end of last year. So now that's adjusted. And if anything, the weakness in the dollar and the slight increase in various forms of term premium, inflation premium in the US Treasury market, that has actually attracted international investors to get back into the long end of the curve. If I look at short utilizations, are people really shorting the long end of the curve despite fears of stagflation and bear steepening? No, they are not. So I really don't think there is an alternative. Maybe along the edges, people will look for positive factors, positive reasons to move into other currencies. But again, that dollar diversification story, I really wouldn't overplay it right now.
Got it, Geoff. Great to get some time with you. Really appreciate it. Geoff Yu there of BNY. Let's get to some of the other top stories trending on the terminal this morning. China makes a thinly veiled jab at the U.S. for threatening world peace. Its assistant foreign minister told reporters that a certain country seeks to put its national interest above the interest of others. China will be hosting Russia's President Vladimir Putin, India's Modi, and Turkey's Erdogan at its biggest annual diplomatic event at the end of this month. And the Trump administration won't look to take stakes in chip makers like TSMC or Micron. Those two companies are slated to invest in the U.S., but unlike Intel, there's no talk of the U.S. taking any equity. Plus, postal services across the world are suspending parcel deliveries to the U.S. That's ahead of the Trump administration bringing an end to the de minimis tax exemption for lower value packages, which starts next week. That affects more than 4 million parcels, which flow through the U.S. each day. Coming up, Nvidia puts a halt on its production of H20 chips. More on that next. This is Bloomberg. Nvidia shares down in the pre-market trade. That's following reports from The Information that the chip maker has instructed suppliers to halt production of its H20 chips. The halt coming after Beijing reportedly asked its tech firms to avoid the company's quote, inferior AI processor. Of course, there are higher technology processors from that company. CEO Jensen Huang spoke to TVBS News in Taipei about the chips earlier today.
U.S. government, the Trump administration, has approved licenses for us to export H20s to China. Recently, China asked some questions about some security backdoors in our chips. We have made very clear and put to rest that H20 has no security backdoors.
For more, I'm joined by Bloomberg Intelligence senior analyst Robert Lee, and this is fascinating on many different levels, Robert. I know that, we had previously, months ago, seen a directive from the Chinese government that that companies shouldn't be buying these chips because of energy consumption issues. I wonder, when Beijing makes those kind of orders, do companies in China listen?
Okay, well, maybe let's just briefly take a step back from these news headlines, etc., and try and understand quickly what the direction of travel is here. And I think there's plenty of evidence for all sorts of reasons, mainly strategic, that China is really gunning for and pushing to achieve technology self-sufficiency for a number of reasons. One of those is to drive so-called new productive forces within its economy, because it looks to the high-tech sector as a driver of future economic growth. But clearly, given these current geopolitical times, the relationship between China and America that once existed is under some strain, shall we say. And also from a Chinese perspective, the US has proved itself to be a somewhat unreliable and unpredictable partner. So no wonder China is doing everything in its power to achieve self-sufficiency. And obviously, given AI is at the core focus of where the technology sector is being developed at the moment, to be self-sufficient and to reduce its reliance on US suppliers such as Nvidia is absolutely what it wants to achieve. So the national champion here, as you're probably aware, in China is Huawei. So there are, again, these unconfirmed reports in recent weeks that Chinese authorities are encouraging local AI companies to use Huawei chips. And then we've had this unconfirmed report emanating from the tech journal The Information that Nvidia has signaled to some of its component suppliers to actually stop or to halt production. So again, allegedly, those companies are Samsung and Amkor, which put together related components to the H20. So I think it's been, the H20 saga continues, regardless of how this ends. I think China is going to continue to push to be self-sufficient in these core technologies for the reasons I've just explained.
Robert, I'm just wondering about the state of the command economy in China, because as it stands in the U.S., when the Trump administration tells corporate leaders to jump, they tend lately to ask how high. And I would imagine Beijing has even more power. However, back in March, when China's National Development Reform Commission advised companies not to buy H20 chips, or rather to buy maybe others instead, it doesn't seem like many of them took heed. So how strong is the power of Beijing to control what Chinese companies do?
Well, I suppose in terms of, from an industry perspective, I think even in this part of the world, people would give full admission to the fact that Nvidia's technology at this point in time remains superior. Nvidia's got a stranglehold on the global market, the supply of these AI accelerators, which are essential to run and develop AI applications and large language models. So really, that until the last 18 months or so, there have been very few alternative providers. But the supply, locally supply, again, which is emanating from the likes of SMIC and Huawei, has risen up significantly. And therefore, given the geopolitical backdrop, it makes sense for local companies to focus on these local suppliers and reduce the uncertainty that comes from being reliant on suppliers coming out of the US.
All right, Robert, thanks so much for joining us. Bloomberg Intelligence senior analyst Robert Lee talking to us about Nvidia. Let's stay with tech right now, because I want to give you a couple of stories that stand out on Meta. First, news that the tech giant signed a $10 billion cloud computing deal with Google. The deal marks the first major cloud computing deal between Meta and Google, and we'll see the Alphabet subsidiary paid over 6 years. Next, more poaching from Meta. Despite a reported AI restructuring and hiring freeze, the company has come back for another Apple executive. Bloomberg sources reveal that Frank Chu is going to join Meta's superintelligence lab. Chu becomes at least the 6th employee to swap Apple for Meta this year. Now let's get a look at the Mag 7 stocks. This week, it's been a rough one for Mag 7 stocks, and that's why we've seen a lot of the drops. Here's a pre-market look at Nvidia, down 1%. Meta, however, little changed, as is Apple, actually showing about a 3% gain to the upside there. Alphabet shares, after news of that Google deal, up 1.2% in the pre-market. Coming up, the Journal reports that Powell plans a U-turn at Jackson Hole. A look at what else is making headlines in your front page news. This is Bloomberg. Time now for your front page news. First up on the Washington Post, the Trump administration's plan to vet all 55 million foreigners with U.S. visas. In an emailed statement, the State Department told the Post that it's looking to revoke visas for overstays, criminal activity, or any form of terrorist activity, which would be great. Next, the Financial Times reporting that Jefferies is telling senior bankers, if you want bigger bonuses, collaborate. According to the FT, Jefferies President Brian Friedman said that to managing directors in an off-site meeting, Jefferies didn't respond to our request for comment. And the Wall Street Journal reports that Jerome Powell plans to make a U-turn on an economic strategy that has soured. The Fed is quietly scrapping an approach to monetary policy focused on the risks of near zero rates and low prices. The Fed chair is expected to lay out these changes today during his keynote speech at Jackson Hole at 10 a.m. New York time. We have special live coverage all morning right here on Bloomberg TV, and we'll bring you that speech live as well. Right now, we're looking at futures that are slightly higher on the S&P as the U.S. 10-year yield holds at 4.33. Coming up, we'll speak with Jack Caffrey of JPMorgan on the rotation in stocks. It is 5:30 a.m. in New York City. Good morning. I'm Matt Miller in for Danny Berger with your Bloomberg Brief. Here's what you need to know. Equity futures rising this morning, counter to the trend we've seen all week of red numbers. That's as markets await Fed Chair Powell's speech at the Jackson Hole Symposium. We'll bring it to you live at 10 a.m. And Nvidia is said to have asked its suppliers to halt production on H20 chips because, well, the Chinese maybe just aren't buying enough of them. Let's take a look at what's going on in the markets. As I said, S&P futures up 0.2%. We've had down days every single day this week, but it's Friday. NASDAQ futures up a little bit less, 0.1% as Nvidia actually falls in the pre-market. And the small caps are gaining the most. Russell 2000 futures up 0.4%. For some of the individual stocks to watch, including Nvidia, let's go to Valerie Teitel in London. Valerie?
Yeah, let's start with Nvidia right there in the red, falling over 1%. This is off the back of those reports from the information that they've halted production of their H20 chip, that chip that was specifically designed to comply with export controls for the Chinese market. We've also seen other chips or other chip-related stocks that are in Nvidia's supply chain, such as TSMC, fall in the red in Asia trade. That stock was down 1.3%. Moving on to earnings, let's talk about Workday. They did come in a miss with earnings, and very interestingly, they agreed to acquire yet another AI company. They're acquiring Paradox to use AI tools in order to automate the hiring process for its customers. That stock is down 4% in the pre-market. Lastly, another AI theme perhaps here, Matt. Zoom Communications jumping 5% in the pre-market trade. They did come out with a beat when it came to their earnings and forecasted some pretty strong sales off the back of a new suite of AI tools that they have produced for their clients, one of those being an AI assistant. Matt?
All right, Valerie, thanks very much. Valerie Teitel there with a look at some of your individual movers this morning out of London. Let's get now back to Wyoming. Fed Chair Powell is set to deliver remarks at Jackson Hole at 10 a.m. Eastern. Joining us now is Bloomberg's Enda Curran. So, Enda, the Wall Street Journal out with an interesting take that he's going to ditch the Fed's framework. I guess they do a review. It's been 5 years since this new framework went into effect, in which they decided or agreed to let inflation run hot. But inflation's running hot right now, and we're expecting a cut in September. So what's the deal?
Well, two things going on. As you mentioned, Matt, that framework is up for review. Around 5 years ago, at that time of non-existent inflation, the Fed basically said, look, they can allow inflation to run over the target for a little while to make up for the period when there was no inflation. That was the thinking back then. It had its critics at the time. But nonetheless, looking back now, obviously, there's a debate among economists about whether that framework was the right approach given the inflation crisis that the US went through over the past few years. So that's up for debate now. One of the topics of the symposium is on this framework. So it's expected there will be some guidance, perhaps, in terms of where the Fed will go on that next. Now, to be clear, not everyone thinks that's why inflation got out of control and why the Fed was seen as being behind the curve. But it's part of the mix, part of their deliberations, and they're they're expected to set new rules of the road, so to speak, for the years ahead.
I guess, the idea was at the time that they wanted an average over the long run of 2%. And since we'd been so far below, they would let it run hot so that it would hit that average. They have no choice but to throw that averaging idea out the window now, right? Because if they want it to average 2% over the long run, they need inflation to be zero for quite some time.
And that's exactly it, Matt, because circumstances are so different now to what they were back then. There's a view that this framework just isn't fit for purpose right now. And you look where inflation is, it's still well above target. We had that scare in the recent inflation data warning, hang on, forget about the tariff side of things. Look what's going on here with services prices, hints of a resurgence on that side of things. So inflation remains well above their target. The officials, this is why there's such a debate about can the Fed ease rates, can they cut borrowing costs in the months ahead or not, or risk stagflation. And in that context, then, that's where you bring in this framework. And I think there are skeptics who say, well, that really isn't setting the kind of rules of the road that we need right now. And by the way, this inflation, we're kind of also in a world where inflation remains both persistent and volatile. And given the backdrop of what's going on with world trade and everything else, that's not expected to end anytime soon. So I think it's seen as a case for debate around this Fed framework.
Do we expect potentially the Fed to just throw out the 2% target? I mean, as debt to GDP is 100% here and we need to inflate our way out of that, does the Fed just say 3% is cool with us, or at least signal that it is?
Well, that would be a big move. I'm not sure the Fed have given signals on the target per se, Matt, but obviously there is a raging debate going on. You often hear economists say, what's the difference between 3% and 2%? Why does the Fed need to get all the way down to 2%? You have the big debate going on at the moment about the depth of the slowdown in the economy with the labor market. Are things slower than we thought? Why isn't the Fed cutting? And of course, you have the political backdrop, which is significant pressure on the Fed both to cut rates for the economy and bring down, as you just mentioned there, inflate your way out of debt, bring down debt servicing costs. Nonetheless, we are where we are, and that is the Fed has that 2% as its main target, and that's why they're so careful in sending such cautious signals about cutting policy in the months ahead, because their great concern is that if they cut too soon or by too much, you end up in a situation then whereby inflation takes off again at a time when the economy is slowing, and that's where you're getting into stagflation and the danger of policy error. So it's a tricky one for the Fed. They were too late on the way up, and now they don't want to be accused of being too late on the way down.
All right, Enda, thanks very much. Bloomberg's Enda Curran joining us out of Washington, D.C. Let's talk now with Jack Caffrey, equity portfolio manager at JPMorgan Asset Management, joins us here on set at 731 Lexington Avenue. Jack, we've had down days on the equity market every single session this week, although we're still hanging around all-time highs, right? 6,400 or thereabouts. What do you expect for this equity market in light of Jerome Powell's speech this morning?
Well, I think to some extent, unfortunately, we have to think that what we're going to hear is, the quacking of a lame duck coming out at 10 o'clock. And we've been hearing we're going to replace, we're going to potentially get more openings on the board to change the composition. And so I do think to some extent you're going to hear about a policy that might have a relatively short half-life, not the 5 years that we've been talking about as a starting point. Second, inflation has become higher and more volatile. I think that makes it more challenging to think about what future earning streams wind up being worth. And ultimately, I think that has been, to some extent, a little bit of the challenge. But, step back. Big picture. This has been ultimately a pretty good year, all things considered. Markets up, almost 8% before we pulled back a touch. And so we've had a bad week in the context of a good year. Perfectly normal, I think, in the scheme of things, when all things considered. And we still get reminded that guidance remains a little bit more challenging as we've winding down the guidance season. We've had some pretty big companies come out and say our future remains a bit cloudy until we get a little bit more policy certainty in terms of what the consumer will wind up paying over the next 3, 6, 9 months. How
does the consumer look to you? Because earnings have been really good, actually, much better than had been expected post-Liberation Day. Expectations continue to rise. But I'm looking at earnings growth, at least from the 474 companies that have reported so far, of 11%.
I almost think we need to rename it. It's not earnings season, it's guidance season. because companies do such a fantastic job of rebasing expectations to what they think they can achieve. You can put out all the caveats you want, and so it's in no one's interest to deliver an unrealistic message and then miss it. The fact is, when we've looked at guidance, you've had, some of the most important companies offer things are a little slower than we would have thought. We're not sure where things are going, and you go down 5, 6, 7% a day. I think as of last week, the average stock was actually down 1% on earnings day. So to some extent, it's not what you did, it's what you can do. And the guidance remains a bit cloudy. And we can sit back and say, tariffs are not in the inflation. Well, the reality is the tariffs really just kicked in on the beginning of August. They're at much higher rates than anyone would have anticipated 6 months ago. We're just experiencing a relief shock, if you will, that they're not quite as bad as they sounded as though they might be in early April. But they're still on the come. Well,
one group of companies that has come away unscathed is the Mag 7. In terms of tariffs, for the most part, right, it doesn't make a difference. Google is still going to spend $80 billion in CapEx next year. Facebook is going to spend $100 billion in CapEx next year. Those numbers just keep coming higher and higher.
And that's why we've had sort of this two-tier market. If we wind up looking through, the Magnificent Seven earnings growth is 13% this year, accelerating to 17% next year on the back of effectively moving cash from balance sheet 1 to balance sheet 2 among the Magnificent Seven. Step away from the Mag 7, call it the forgotten 493. That's where you actually, I think, need that tariff policy. You need that fiscal policy to be a little bit clearer. Who's going to get what spending cuts will happen when, in terms of, if you think about the healthcare industry, been a particularly volatile place. There you see earnings growth accelerating from 3% to, call it 13%. So actually the earnings acceleration into 26 is much stronger away from the Magnificent Seven, even though the scale of the billions we're spending is almost unimaginable a few years ago. It's kind of reminiscent of some other industries, whether it was the build out of fiber in 2000, 2001, or if you will, even the fracking industry, where fracking was going to forever set us free to infinite supply of oil. Sometimes those investment surges don't quite work out as cleanly. They work out great for one or two people, but the 5 or 6 others who are competing find themselves saying, was it all worth it?
Are there industry groups, Jack, that you think stand out aside from tech and communication services?
Well, I think there are two interesting places to be looking right now. I'm more of a value investor, so I'm going to naturally try to gravitate to things that people are not as frequently talking about. What I'll come back to is utilities. Here's a group trading about 80% of the broad market multiple. And to some extent, when we think about artificial intelligence, there are seemingly two gating factors. Access to an Nvidia chip, that's what everyone wants to talk about. And then there's the power to actually turn those chips on. I think that's where things get interesting, because it's probably the first time in a long time that people have talked about utilities as growth stocks. Second, that growth is actually not being set necessarily on the basis of wild ambitions, but instead, I want a contract from my buyer and then working with the regulators to make sure that I have a balance sheet that earns an adequate return on that capital that we're about to spend, to actually make sure investors get paid something for having put up the money, whether that's credit investors or equity investors. So add that with a 2.5% dividend yield against a longer-term forecast of 7% equity returns. It's kind of an interesting place to start.
Where else do you find value? We were talking to Howard Marks the other day, and he said, things are looking seriously frothy. So maybe he doesn't see it yet.
Yep.
But
well, I think historically, what's been our biggest source of inflation in the West, it's been energy prices. Energy is to some extent being abandoned. And yet it seems like the world's energy markets are actually providing the stimulus to the consumer right now in the form of lower prices at the pump. I think the stocks, again, you're trading 75% of a market multiple, 3.5% dividend yields. So you actually get paid something to be somewhat patient when you look at energy. And ultimately, in the world we still live in, oil does make the world go round. I do think you have to take a somewhat longer term horizon. But in that view, I think it makes both an interesting hedge against a world where inflation might run hotter and be a little bit more variable. Second, managements are not drill baby drilling. You've seen the rig count go from 589 in the U.S. to 539 over the past, call it 7 months. So to some extent, lower prices are potentially curing lower prices. And with a 3.5% dividend, you are incentivized to be a little bit patient. And that higher energy in the future, particularly from natural gas, is again making its way into higher utility bills that are potentially, a bit of an offset against, the pump relief. But you pay the gas tax effectively weekly when you fill up your car. You don't perhaps notice what the gas surcharge that's running through your utility bill is because it's buried with 8 other lines.
It's amazing. I would expect energy to already have soared due to the demands of data centers. But when I look at the S&P 500 and break it down into industry groups with my GRR function on the Bloomberg, year to date, it's just done nothing yet. Yet, maybe the key word.
Well, I mean, ultimately, energy is a sector when you get it right. You're up 50%, as you were in, say, 2022, when everything was going down. And when you become effectively a 2% sector, you can effectively double, and wow, you become 3% of the S&P. But I think that's where, to borrow from an idea from Howard Marks, to do better than your peers, you can't look like your peers. And so ultimately, you have to find yourself asking yourself, where can I find an interesting idea people don't want to talk about because it's unfashionable, it's old economy, but where management's doing the right thing, they're giving you a reason to be patient with them, and you effectively wind up getting exposure to protecting yourself from what normally goes wrong in a growth-dominated market.
All right, Jack, great taking some time with you. Thanks so much for coming and joining us. Jack Caffrey there from JPMorgan. This is Bloomberg. Nvidia has instructed its suppliers, including Samsung and Amkor, to stop production of its H20 chips, this according to the information. The halt comes after Beijing reportedly asked local tech firms again to avoid Nvidia's AI processor. Shares are down by more than 1% in pre-market trading, and of course it's a huge stock, so it's important to watch. Take a listen to CEO Jensen Huang speaking to TVBS News in Taipei about the chips earlier today.
U.S. government, the Trump administration, has approved licenses for us to export H20s to China. Recently, China asked some questions about some security backdoors in our chips. We have made very clear and put to rest that H20 has no security backdoors.
For more, Valerie Teitel is back with us. And Valerie, this is interesting because he is implying, or this report is saying, that the Chinese are again advising local firms not to buy the H20 chips. They already did that in March. Is it finally happening?
Oh, well, look, the one thing that's really the key to focus in here on what is really China's aim in doing this. Yes, they have warned local firms repeatedly recently not to use the H20 chip, warning of security concerns. But this could also really be seen somewhat as a power play maybe by the Chinese government because they want, frankly, better chips. The H20 chip is a chip that's essentially not as good as Nvidia's top-tier Blackwell chip. And perhaps this is a message from the Chinese government that they want export controls lifted, especially when it comes to their more sophisticated processor, that Blackwell chip. That was something that President Trump kind of teased a few weeks ago in the Oval Office, saying that the CEO, Jensen Huang, wanted to come see him about a better chip for the Chinese market. But big questions really on, is this already impacting demand for Nvidia? Remember, it was just a few weeks ago that Nvidia even got these export licenses back on track for the H20 chip after the U.S. government suspended those export licenses back in April. We've seen the likes of Nvidia trade lower in the pre-market. We also had one of their key elements in their supply chain, TSMC, trade lower as well over in Asia.
All right, Valerie, thanks very much. Valerie Teitel there talking to us about Nvidia, and it is trading down, as she mentioned, in the pre-market. That's a more than $4 trillion stock and does tend to weigh on the S&P, although S&P futures are up. NASDAQ futures not quite as much. Let's get over to Washington, D.C. An official telling Bloomberg that the Trump administration will not seek equity stakes in chip makers such as Micron and TSMC. If you were waiting for that, because those chip makers are boosting their investments in the U.S. Maeve Sheehy of Bloomberg Government joins us now from Washington. Maeve, to me, it would seem like NINSS, right? Because this administration is going to want to invest in, take equity stakes in American companies.
Yeah, the administration has been very clear that they want to take equity stake in companies like, for example, Intel. That's been the big one recently. But these bigger companies that are kind of putting their operations in the U.S., increasing their U.S. investments, the Trump administration does not appear to be interested in equity right now, which is really interesting. There's been this kind of debate between free market Republicans who are saying that the U.S. government should not be taking equity in private industry. So it's a really interesting debate that's playing out here.
Yeah, that is fascinating that there are still free market Republicans. You're in Washington, D.C. That must be an incredibly rare breed in this protectionist party.
Yeah, you are seeing a more protectionist lean in the party, but you're also seeing there are still some traditional free market conservatives, especially in Congress. You have people who were elected, decades ago at this point and are kind of clashing with the more isolationist wing of the party. And you're seeing that in, economic issues. You're also seeing it in foreign policy.
The argument is that this is really a national security move more than, a centralized economy move. Is that winning over people in Washington? Because obviously, if we were to go into a wartime footing, we would want to have our own suppliers of chips.
Yeah, so I'll start with the caveat that it is August, so lawmakers are on recess, and we're not hearing as much from them as we would normally. It does appear that the Trump administration is generally winning over Republicans with trade issues and economic issues like this one. And with specifically the Intel deal, you hear the Trump administration saying that basically the Biden administration was giving away grants for free with the CHIPS and Science Act, which was President Joe Biden's one of his big signature legislative accomplishments. So you are seeing the Trump administration use that argument to say, they've given this money away, but they want to have some equity in exchange.
All right, Maeve, thanks very much. Maeve Sheehy there of Bloomberg Government, coming to us out of Washington, D.C., where free market capitalists are surely a dying breed. Coming up, we're going to get you set up for your trading day with everything you need to know. This is Bloomberg. This is Bloomberg Brief. I'm Matt Miller in for Danny Berger here in New York City. Let's take a look at what's ahead over at Jackson Hole. Boston Fed President Susan Collins will be joining Bloomberg Television at 9 a.m. Eastern. We have a special event planned for Jackson Hole coverage. Tom Keene will be joining you along with Lisa Abramowitz. At 10 o'clock, it's the main event. Fed Chair Jay Powell will make his remarks to Wall Street Journal saying that he's going to announce a change in the Fed's framework. They no longer need to let inflation run hot, even though inflation is running hot. That's followed by former Fed Vice Chair Richard Clarida at 10:15. A friend of Bloomberg Television. You'll want to watch that for sure. And then in terms of the market today, get ready for Nvidia to pull down the indexes. The information reports the chip maker is halting production of its China-specific H20 chips. This is Bloomberg.